The Committee on Capital Investment will begin. It's March 4th, 3 o'clock. Committee has come to order. First up on the agenda is Eric Kim, Senior Director and Head of the U.S. State Ratings for Fitch Ratings. And I think Mr. Kim is via Zoom.
Yes, I am.
Oh, there you are. And it says Fitch Ratings right there in your background. So go ahead and, just state your name for the record and then go ahead with your presentation. Thank you, Mr. Kim.
Thank you, Madam Chair. Eric Kim from Fitch Ratings. Let me just share my screen here. Like this. Everybody see that okay?
Nope, we can't see it.
Oh. We can see this though, right?
No, we see you, Mr. Kim.
Oh, 1 second.
Let's see, Jack's, oh wait,
hold on.
hang on. There we go. Got it.
There we go. Okay, let me see if I can get this now. Right, slideshow settings. Is that right?
Yep, there you go.
Okay, fantastic. Okay, so again, thank you, Madam Chair. Good afternoon to the members of the committee. My name is Eric Kim. I am an analyst at Fitch Ratings. I manage the
Oh,
U.S.
Mr.
State
Kim?
Ratings team. Yes.
Can you just speak a little bit louder? It's really quiet on this end.
Oh, apologize. Is this any better?
If you can get louder, I'm sorry. Let's see if is it on our end or no? Yeah, speak again, Mr. Kim.
Let me see if I can change this step.
Okay.
Is this any better?
Not really.
I'm sorry. Coming in. Was that better?
Hang on 1 second. We're going to call a sergeant to see if they can come here in our room and turn it up for a second.
Okay. Apologize.
Hold, please. No, it's not you. Hang on. Mr. Kim, just another couple minutes. I hope you're okay.
I'm fine. I'm fine.
Okay, great. Thanks. Okay, Mr. Kim. Can you hear me?
Yes, Madam Chair. Can you hear
Okay,
me?
so can you see in your Zoom settings, if they're in Zoom, there's a way to turn up your volume?
I can change this microphone I'm using.
Arrow for audio settings.
Yep. Let's see, my output level, I can turn that up. Is this any better?
Jack, you can talk to. Okay, it's all the way up, you said, Mr. Kim?
Yeah, that's all the way up. It's the highest level on my end.
Okay, well, we can hear you, but if you could kind of like yell
Okay.
as loud as you can will help us, because it's quiet in here, but if we're quiet and you're loud, I think we'll be able to hear you.
Outdoor voice.
Yeah, your outdoor voice. Go ahead.
My outdoor voice. Okay, I will try my best. Okay, here we go. Thank you, Madam Chair. Good afternoon to members of the committee. My name is Eric Kempf, and I'm an analyst at Fitch Ratings. I manage the U.S. state ratings team for Fitch, and have been with Fitch since 2007. Thank you for inviting me here today to talk about Fitch's rating criteria and how we apply it to the state of Minnesota. Joining me today on the line are Brian Quevedo and Tammy Gammeren, who are the analytical team that covers Minnesota for Fitch. I have a slide deck that I'll walk through, and hopefully all the members receive the deck along with several reports that I sent along. I'll make some reference to those reports during the presentation. And I'm happy to take questions as we go through the deck or at the end, whatever works best for the committee. So with that, this is an overview of what I'll be covering with my presentation. First, I want to lay out exactly what a credit rating is from Fitch's perspective, which I think will also help clarify what a rating is not. Then I'll briefly touch on our rating process, just to give the committee a general sense of how we do our work and ultimately get to the ratings and the research that Fitch publishes. I'll touch on the distribution of Fitch's ratings for the 43 US states that we currently rate publicly, and also give you a sense of recent rating trends for US states. Finally, I'll dive into our rating criteria, which is our explanation and our guide for how we determine our ratings for all the states. And I will walk through how that criteria applies to the state of Minnesota and the AAA stable rating we currently maintain. So, what is a credit rating actually? One of the reports you have is entitled Rating Definitions. It explains the different types of ratings and scores and assessments that we provide and what the different scales mean. And for our purposes today, a rating is fundamentally Fitch's opinion on the likelihood and willingness of a borrower to repay its debts. We use a scale from AAA all the way down to D, and we use plus and minus modifiers to help distinguish credit quality. The key point here is that it's an opinion. It's an opinion grounded in hard data and analysis and well supported, but at the end of the day, it's simply Fitch's view on an entity's credit quality. And in addition to the rating, we also provide guidance about where we think a rating is headed. That comes in the form of outlooks or watches. You heard me say earlier that we rate the state of Minnesota AAA stable. That means our issuer default rating for the state is AAA with a stable outlook, which means we expect the rating to remain at the current level. Now, outlooks are over a 1 to 2 year period, can be stable, positive, negative, or evolving. Positive and negative are self-explanatory. Evolving means the situation is, well, evolving. We're not sure of whether things are moving in a positive or negative direction, but we do expect some kind of change. A rating watch is generally more event-driven or time-sensitive. Watches usually mean we expect a rating could change within 6 to 12 months, often based on a specific event occurring, like completion of a merger for a company. So let me talk a little bit about the mechanics of how we arrive at our rating. Another report I provided the committee with is entitled The Rating Process. This report goes into a lot of detail about the actual steps involved in requesting and obtaining a rating from Fitch. The chart here is a little bit of a condensed version of that report. There are a few key points I want to highlight about the rating process. First, every entity we rate has an analytical coverage team that is responsible for being the experts on that entity. For Minnesota, Brian is the primary analyst and Tammy is the secondary analyst. And again, they're joining me here on the call. In terms of actually getting to the rating, that process happens in a rating committee. That's a meeting of rating analysts where we discuss the recommended rating the primary analyst presents. Ultimately, we arrive at a consensus view of what we think the rating is. We publish that rating and research that helps explain our reasoning. And at least once a year, we do what we call rating surveillance and gather data and information that's changed since our last rating. We put together another rating committee and update our view on the rating. We could keep it the same, we could change it, we could revise the outlook or apply a rating watch. And then we publish the updated rating and any research that again helps explain our rating. Now I want to share some information about our distribution of ratings for US states and what we've seen in recent years in terms of ratings trajectory. So another one of the reports I provided to the committee was our current ratings and analytical coverage report. This map simply visualizes the ratings data. Our average rating for a US state is between AAA and AA+, which are Fitch's two highest possible ratings. We consider state governments as a whole to have very limited default risk. On this next slide, I have some information about rating trends. On the left chart, you've got a history of rating upgrades and downgrades for state issuer default ratings for the past 3 years. You can see some pretty clear positive momentum in 2022 and 2023. Then in 2024, no change at all in state issuer default ratings. On the right-hand side, we've got the balance of rating outlooks. You can see that the vast majority have been stable for the past several years, but also that we have 6 states on a positive rating outlook as of the end of 2024, which indicates that we do see some positive rating momentum. So now I'll turn to the actual analysis that we do in order to determine credit ratings at Fitch. Earlier, I spoke about rating criteria as our guide and explanation for how we determine ratings. For every type of entity that we rate, whether it's a state or a local government or a water utility system or a large corporation or even a sovereign nation, we have rating criteria. Now, one of the reports I've provided to committee is our US state governments and territories rating criteria. Now, our criteria start by looking at what we call the sector profile, which means the general environment that all states operate in. For US states and territories, that sector profile is strong due to several factors, including the strength of the US economy and the preeminence of the US dollar as the world's primary reserve currency. Then we look at the economic resource base for the specific government we're rating, focusing on economic levels and trends to determine the capacity of a government to continue repaying bondholders. Finally, we look at 4 key rating drivers, or KRDs. We assess each of these with a letter grade, very similar to the overall rating scale, but with no pluses and minuses and with lowercase letters to help distinguish them. We weigh those factors and then determine Fitch's overall rating. On this slide, you have an excerpt from page 6 of the criteria report, which gives a summary of the different KRDs and the way we determine our assessments for each one, including the guidance metrics that we use. So let's talk about how we apply the criteria to the state of Minnesota. And one of the reports we provided to the committee is our most recent rating report on the state of Minnesota. This one is from last July. This slide includes some of the data points we use in assessing the strength of a state's economic resource base. We're looking at both overall levels for these metrics as well as the growth trends. And here we have an historical table that compares Minnesota to the US on a few key metrics covering the labor markets and general economic conditions. Overall, we see Minnesota's economy as well diversified and healthy, providing a strong foundation for the state's credit quality. So the first key rating driver, or KRD, we assess is revenue framework. For Minnesota, we view this as AAA. I should note that for several of our key rating drivers, we have sub-factors that we're also evaluating. For revenue framework, we have 2, growth prospects for revenues and independent legal ability to raise revenues. Now for Minnesota, the state's strong economic foundation and the structure of its tax system means the state government is able to generate revenues at a healthy and sustainable way, which we expect to continue. Now, for this and the next few slides, I'm also including some of the key metrics we use to make our assessments and the guidance that gets us to different assessment levels. The key metric we use here is historical revenue growth compared to national GDP and inflation. And Minnesota's revenue growth has generally been in line with nominal US GDP growth. We also assess Minnesota's second KRD, expenditure framework at AAA. One of the key metrics we consider for this key rating driver is what we call carrying cost. So that's the portion of a government's annual spending that's dedicated to debt service, pensions, and OPEB. You can see from the chart included on this slide that Minnesota's carrying costs, which are in blue, are low relative to the US median and well below 10%, which is our criteria guidance for AAA assessment. Next, we look at the state's long-term liability burden. And again, we assess this key rating driver at AAA for Minnesota. The key metric here is direct debt plus pension liabilities compared to the state's personal income. And here again, Minnesota is well below the state median, or below the state median, I should say, and also within the criteria guidance for a AAA assessment. This chart gives you some more context about our assessment of long-term liability burdens across states. This comes from our annual report on long-term liabilities, which you have a copy of as well. That's the report titled U.S. States Sector Monitor 2024 State Liability Report. This chart comes from page 2 of that report, and it shows the long-term liability burdens for all the states along with the median. You can see Minnesota there noted with the blue arrow. And then we get to what we consider the most important of the key rating drivers, operating performance, where Minnesota is also AAA. We like to think of the first 3 key rating drivers as the building blocks for a government's fiscal performance and its willingness and ability to repay bondholders. Operating performance is Fitch's view on how a government has historically made use of those building blocks to maintain fiscal stability and how we expect the government to behave and respond in the future. The Fitch does not have explicit weighting for its key rating drivers, but we do consider operating performance to be the most important one. It's the clearest place where things like the government's policies and practices come into our rating. One of the key parts of our assessment on operating performance is the scenario analysis. We use a model that we call FAST, the Fitch Analytical Stress Test, to help us compare how state revenues have fared during economic downturns. For example, FAST tells us that California and natural resource heavy states like Oklahoma and Wyoming have been more susceptible to big revenue drops when we hit a recession. But other states like Kentucky and Maryland and Vermont tend to have much more stable revenue performance through a downturn. And Minnesota falls into this second bucket. The state's historical tax revenue performance has been relatively stable when compared to national economic trends. So we use the FAST results and our analysis of the different budgetary tools that a state has to manage through a downturn to help us get to the operating performance assessment. And then with those 4 key rating driver assessments, the rating committee then determines the appropriate issuer default rating for the state, again, weighting the operating performance most significantly. And for Minnesota, that comes out to a AAA with a stable outlook. And that wraps up my prepared remarks, and I'm happy to take any questions that the committee may have, and hopefully you were able to hear any of that.
Thank you, Mr. Kim. Yes, we were able to hear you. Everybody stayed quiet in the room. Senator Nelson, did you have a question?
Yes, it might have been addressed, but I'm just looking on page 19 at the state revenues and expenditures and unaddressed stress.
Yes.
And I note the dotted line in 2024, and looking forward, it appears something that I think we know because we have known for at least a year now that we have a structurally imbalanced budget. But it is concerning, and we just have black and white copies. So just to make sure, it appears that our state expenditures are increasing beyond. In 2024, our expenditures and our revenues were the same. But 2024 on, it appears relatively worrisome that our state revenues are outpacing our expected state expenditures. And I just want to clarify that that's actually the case. And by what magnitude is
Right.
that? It's very scary. It's not a good position to be in.
No,
Mr.
thank
Kim.
you for the question. Thank you, Madam Chair. Sorry about that. So I think that there's a few things that I want to highlight here. One, what we're showing in the scenario analysis is not intended to be a forecast. If you spoke to the folks at the Minnesota Office of Management and Budget, I'm sure they would give you their own perspective on what their expectations are. I'm sure your legislative fiscal office probably has its own views on the expectations for kind of the long-term fiscal outlook. That is not what this scenario analysis is intended to do. It's not a forecast. It's a way simply for us to put all the states we look at on somewhat of an apples to apples comparison basis and get a sense of what could happen in a unaddressed stress. And that's pretty key, unaddressed. If revenues performed in the way that the FAST model indicates and expenses grew essentially at a projected rate of inflation with no changes. So that is an unlikely scenario. And I think for most states, if you look at the scenario analysis that we produce, you'll have a similar dynamic where you will have the, in color, you'll see the revenues, the red line, you'll have the red line dipping below the blue line on the expenditure side, because this is intended to signal, again, an unaddressed stress scenario of a recession. So it's not surprising that in a recession, a state's revenues would decline. And if we left expenditures alone, as we are doing here for the purposes of this scenario analysis, that they would exceed the pace of revenues. So that's not surprising in and of itself. Again, it probably is the case for most states in this particular scenario analysis. But again, this is not intended to be our view on what will actually happen in terms of the state's long-term fiscal outlook. That's not something that we're trying to replicate here. We do rely on the work of the state budget offices and independent parties to come up with some of those analyses and evaluate those. In terms of a structural deficit challenge, that is an important consideration for Fitch. And I think the situation we've had over the past probably 3 or 4 years coming out of the pandemic, where many states were seeing enormous revenue surpluses, that was very unusual. Those of you who have been in the legislature or been in state government know that prior to that, most years begin with the state facing some type of deficit and the legislature having to craft a budget that addresses that based upon, starting with the governor's recommendations to do that. So, and that is the case for most states, that most states are regularly in a position where they are addressing deficits as they craft their budgets. Our view is that states have that capability to do that. They have the power in terms of managing their budget on the expenditure and revenue side to make those adjustments. So starting off the year from a deficit position in terms of looking at the next year and trying to manage that is not in and of itself a concern. It's how the state does that and whether the actions taken are recurring and sustainable. That's what we focus on.
Senator Nelson, follow up.
Just to follow up, thank you for the further description. As you were beginning those comments, though, did you say something about a recession, that this is typical in a recessionary period, but it was a little muffled. Can you reiterate what you meant by this type of scenario and a recessionary period?
Mr. Kim.
Thank you. Yeah, well, let me try to clarify. So what you're seeing here on this slide is our scenario analysis. So again, it's not intended to be a forecast of what we expect to actually happen for the state. It simply shows that in a stress scenario of a recession, if revenues decline in the way that our FAST model suggests that they could, and expenditures increase at a constant rate, essentially the rate of inflation, this is what could result. So in that context, it's not surprising that in a recession, revenues go down. If we don't change expenditures, they'll continue to go up, so that there will be a gap. But this is an unaddressed stress, and we expect, and we've seen historically, states do actually address these kinds of scenarios and don't leave themselves in this position on a long-term basis.
Senator Nelson.
Just one little follow-up. I do not recall, I know there's been a lot of discussion about a concern about a recession, but I didn't, I guess are you saying that this looks like a recessionary graph? And I just explain what you mean using the word recession when we're looking at this particular chart here.
Mr. Kim?
So the dotted line represents, on the left-hand side is actuals, the right-hand side is the look forward. That's the scenario. And the scenario, which we apply to all states, is a modest U.S. national recession. So that's what the stress is. It's applied to all states. And by applying it consistently, we get a sense of how might revenues and expenditures look across the states and what kind of challenges that mean for each particular state. So we're not forecasting a recession. This stress allows us to apply a consistent scenario across all the states because our ratings are intended to be stable through an economic cycle. Our goal is to have a rating that if the U.S. hits a downturn, a normal downturn, which is inevitable, right? That's how business cycles work in our view. When the U.S. hits a downturn, we don't intend to downgrade every state rating just because we've hit a recession. Our ratings are intended to be stable through a typical economic cycle, and this kind of scenario analysis helps us do that by helping us think through and visualize what could things look like in a recession scenario.
Thank you.
Oh, good, Senator Nelson. All right, Senator Pappas.
Thank you, Madam Chair. I just want to refer to page 17, which is our long-term liability burden, and just have a little bit more understanding of where Minnesota is. So when you talk about as a percentage of personal income metric, that's one of our guidelines by Minnesota Management and Budget. But we also have a guideline that says so much of our debt has to be paid off within a period of time, 40% in 5 years and 70% in 10 years. And we're just wondering if that's, a guideline that Fitch would consider a good thing, or would you be neutral on that? Or are there or is this percentage personal income more important? Or just, do you have a position at all on our guidelines?
Mr. Kim.
I can speak to what we focus on. And what we focus on are really two things when it comes to long-term liability. So this metric here, relative to personal income, and that we use personal income as a proxy for the economic resource base. What is the capacity of a government to access that resource base in order to repay the obligations it has outstanding? So the lower that metric is, the better. The other metric that does relate to long-term liabilities is the one that's on slide 16, which is carrying costs. So that is essentially the annual budgetary burden, the bite of debt service and other long-term liabilities, pension liabilities and OPEB liabilities, the annual costs associated.
Can you remind me what
those-
OPEB is? Sorry, Madam Chair.
OPEB, sure. Do you want me to answer that?
Yes, go ahead, Mr. Kim.
Sorry. Other post-employment benefits. So
okay.
that's essentially healthcare for retirees and independents. So the annual costs associated with those long-term liabilities, again, debt service, pensions, and OPEB, that's the other way that we bring in long-term liabilities into our analysis. So the criteria, and on this slide actually, and the next slide, you've got the guidance for how we think about those metrics, where they fall, and what kind of assessment level that corresponds to. Some of the other things you spoke about, amortization is the way we term it, how much debt is retired within X period of years. It's not a critical rating factor for our consideration. There are policy reasons that the state government may want to focus on those. And that does relate in indirect ways to some of these other metrics, such as the long-term liability burden and the carrying costs. So those aren't as critical for us, the amortization metrics, when it comes to state governments. But that doesn't mean they shouldn't be important for you from a policy perspective.
Thank you.
All right, members. Senator Pratt.
Thank you, Madam Chair. I think Senator Pappas raised kind of an interesting point in your presentation, using personal income as a proxy for the economic resources available to repay. And it seems like a lot of the factors going into the rating are more aligned with pension debt than they are necessarily direct debt. maybe based on the state, but have you ever looked at debt capacity or understood what percentage of a state's budget should be assigned to debt repayment?
Mr. Kim.
So we focus on both pension and direct debt. So if you look at this chart, actually, it's a little clearer on the next one. So this is slide 18. So if you look here, you can see that this gets broken up. This is the long-term liability burden as of our last annual report. Again, you have a copy of this report. And the liability burdens for each state are shown as percentage of personal income. And you can see this, well, I guess you can't see because you don't have it in color, but there is a blue and a red portion for each state. And the blue portion is the direct debt portion of the liability, and the red portion is the pension liability portion of the long-term liability burden. So we do consider both. So it's not just pension liabilities by any means. And I'm sorry, the other piece of your question?
So,
Senator Pratt.
thank you, Madam Chair. I forgot protocol. So I'm curious around debt capacity or debt burden. Do you ever look at or have any thoughts on how much of a state's budget should be dedicated to debt repayment?
Mr. Kim.
Yeah, so that piece, I think, comes in most clearly in the carrying cost, where we look at, again, the annual budgetary costs for debt service, pension liabilities, or pension repayment, and OPEB payments as well. So we do not provide policy guidance for governments, right? That's not our role. Our role is simply to assess what a government is doing and then provide a credit view. And you can see here that our credit view is that carrying costs that are generally less than 10% are reflective of a AAA assessment for expenditure framework. So, and so forth and so on. You can see the specific metrics here. So that is our view in terms of the implications for credit quality. Similarly, when it comes to the long-term liability burden as a percentage of personal income, we have guidance as well for where different levels of long-term liabilities relative to personal income, what that reflects in terms of our assessment and ultimately the rating for a state. So that's what we provide, and that's what we can opine on in terms of the implications of different levels of debt and long-term liabilities.
Senator Pratt.
Thank you, Madam Chair. And when you're looking at that 10% carrying cost, that's the pension, OPEB, and debt combined when you're looking at 10%.
Mr. Kim.
Correct.
Thank you.
Senator Pappas.
Thank you, Madam Chair. Mr. Kim, I'm just looking at the chart on 18. For example, it shows Illinois with we know they have a huge pension debt. And then I look back on page 7 where we're looking at all the states, and we don't have color printouts. It's too expensive. We're just much too cheap to do color printouts. What is Illinois' rating? Are they a AA or an A+? I'm not clear what they are.
Illinois, sorry, just wait for the chair.
Oh, Mr. Kim, sorry. I was like, oh, we just went
What's he
silent.
waiting
Mr.
for?
Kim, sorry.
No, I apologize. Illinois is A- with a stable outlook. It's our lowest rated state government and has been for a number of years.
Senator Pappas.
Thank you, Madam Chair. So could you just give me a sense, everybody, all these are A students, I see. Nobody gets an F or a D or even a C. But just realistically, we kind of pride ourselves on having a AAA, but what's the difference between a AAA and an AA plus in terms of, say, what we might pay in interest?
Mr. Kim.
That is not a question that I'm positioned to answer, unfortunately,
Okay.
because my role is to provide the ratings. I think probably the team that manages the debt issuance for your state might be able to offer some insights there.
All right, thank you.
Members, any further questions of Mr. Kim? All right, thank you, Mr. Kim, for joining us today. It was very
Thank you.
informative. Thank you. Next up, we have Assistant Commissioner Kevin McKinnick from Minnesota DEED. Welcome, Assistant Commissioner. Oh, so, yeah, you know what you're here for, Mr. McKinnon, but an update on the 23 grants. Go ahead when you're ready.
Thank you, Madam Chair, and members. Kevin McKinnon, Deputy Commissioner of Economic Development at DEED. And while my colleague Nathan is getting the PowerPoint up, I will provide an update of the 23 appropriations that we received, along with just give you a refresher on our grant process overview. So from the perspective of how these are managed at the state, we work very closely with Minnesota Management and Budget on these projects. They play a significant role with us in administering these projects, as does the Department of Administration. When projects are over a certain threshold, they approve all the designs and other pieces of the actual development. So our pre-grant application requirements, we work obviously directly with the grantee, and we try and help that grantee manage those projects. Bond funds can only be used for the items listed in the grant appropriation language and/or appropriate costs as a result of the construction of whatever the project is that we're building. Our grantees are discouraged from beginning work before they actually receive permission from DEED. Work done before enactment, basically, of the laws will not be reimbursable with grant funds unless it's officially stated in the law. We see that once in a while where the legislature has indicated that we can go back a certain amount of time. And then after project completion, another piece that we deal with, particularly with a lot of the nonprofits, is that the use and function of the project cannot change over the useful life of what we've invested in. And useful life in a lot of cases, particularly when you're looking at real estate, can be 20 to 30 years. So this is another one of the requirements that we go through with our grantees. In some of our application materials, there is a capital project checklist that's provided through MMB as well, which provides a variety of questions related to the project, such as public purpose, qualified expenses, et cetera. We look for the work that they've done at the local level. Of course, we don't do anything at the local level, but the projects will have to get the appropriate permits and zoning, et cetera, that we will ultimately verify. Prior to grant approval, we do involve MMB, obviously. MMB is very helpful in explaining some of the requirements, some of the things in the grant agreements. But more so, their role is to approve full funding. And so we will not be signing grant agreements until there is full funding for projects, and we know that these projects can proceed and they can be completed. Again, I mentioned the state architect, and when they get involved with design approvals, it's with a threshold that you're investing in a building. So we work very closely with that office as well. When it comes to implementation, there are a lot of requirements that the projects must go through. They must be obviously competitively procured. So if you're hiring a construction company, you need to get bids. Projects are insured. We look at contractor lists, obviously, for prevailing wage, and then ultimately for the certificate of occupancy, which basically means they can go in and start using the building. When it comes to other uses within the actual building, sometimes there's grants that are done to individual organizations, and those organizations may have others that are occupying the space that the state paid for. And in those cases, we would enter into what's called use and lease agreements. And basically, MMB gets involved with a lot of these, which are required basically by the operator of the state property being financed. And we just need to know what the use is, who's involved in this, and that it's documented into the contracts. In our grant agreements, this is another piece that we try to explain to people up front, is that you must have a grant agreement in place before you can request any reimbursement. And when I say reimbursement, that means they must go expend some funds, and then we will reimburse them for those costs. We don't pay upfront in cases like this, and so it's all done on a reimbursement basis. We would obviously check that the expenditures are in line with their budget and eligible before allowing the payment request to go through. There's a variety of items in these grant contracts that people need to understand, and that's what we stress with our grantees as well, is that they are conversant in all the elements of the grant contract and they understand what they all mean. There is a prohibition on administrative costs, which I think everybody here knows. These projects, we do not allow any administrative expenses for the organizations to complete the projects. We aren't allowed to take admin off of these either. That is just a policy here of the state as well. And finally, as it gets to grant monitoring, annual reports are due every year, and certainly a final report when the project is complete. We provide all the forms and hold back 10% of the project until we actually do receive all the forms that the project is ready to be closed out. All grants are monitored at least once over their lifetime, and larger grants are monitored probably more frequently. We're often out in construction projects where it might be 2 or 3 years. You may see progress at each stage of the visit, but we do actually go out and take a look at the projects and monitor them the way through. So with that, I will get to the appropriation update. In 2023, we had, I believe, $440 million or so from the capital investment budget for over 120 projects, local projects, whether that be through local units of government or through nonprofits. Where we are today, we have 46 of those are in place and projects are proceeding. About 140 million or so of those projects. There are 3 in other stages of grant agreements. Those might be waiting, as an example, for me to sign, or they might be in the process of gathering signatures at the local level, et cetera. That's another 13 million or so from those projects. We have 68 projects that are still in process and all at various stages. You can see 30 or so are local units of government, a little bit more nonprofits, and roughly 200 million or more in outstanding available appropriation. This is actually quite common when we do receive capital investment projects through the bill. This money is obviously available for a longer term than the general fund. projects, so this is not a surprising number as far as we're concerned, as people still go through their project assembly. And I'll talk a little bit about that here in the next slide, which basically those that are still in process, some of them still lack full funding. And as I mentioned, one of the requirements that MMB checks is full funding, the full funding requirement. And so a high majority of the 60 some odd projects that are still there are still trying to fundraise and get their capital. Some of the projects, obviously, you could imagine in the last couple of years, project costs have increased. We know some are facing that. Some of the projects required legislative fixes, which are before you or have been before you. And in some cases, the grantees have yet to produce some of the documentation that is actually required in order to effectuate a grant contract. So we continue to work on these. We continue our staff meeting every 2 weeks to discuss these projects, to discuss challenges, to discuss, to ensure that everybody is sort of managing these all the same way, and the grantees are getting the service that they need, and that they're getting their questions answered. So we continue to obviously work with a lot of these projects. So with that, be happy to answer any questions, Madam Chair.
Thank you, Assistant Commissioner. Chair Pappas.
Thank you, Madam Chair and Assistant Commissioner McKinnon. I think that Chair Housley and I would be really interested in seeing the last category, the grant agreements that are still in process. I know I've been asking my members, how are your 23 projects going? And they've all said fine. So I'm really curious as to who's not fine, because sometimes I say sometimes you may need a modification. Like maybe you need to do phase 1 of your project, but the language has to be modified, because if you say construction, we wait till you have all the money ready before you can do construction. So is there some way that we can help you move it along? And Commissioner McKinnon, if you have any advice for us, we're certainly interested in hearing that. And I would like to see those, and I'm sure Chair Housley would also like to see that list.
Assistant Commissioner.
Madam Chair and Senator Pappas, we would be happy to provide that list, and certainly as required, some of the issues that maybe some of these projects are facing. I would highly encourage, as we do to the actual projects, that you are reaching out to them. We're encouraging them, if they do need legislative fixes, that they need to help speak with, or they need to speak with you all as well, so you can understand why and what the change may be. A lot of the work right now, I can guarantee you, is fundraising. And if there's not enough, if they don't have the funds to obviously complete the project, that's something that we deal with. And I know for a fact there's 2 or 3 projects that I'm very familiar of that are seeking funding from other organizations and or potentially other state agencies in order to complete their projects. And so we continue to wait for those to go through their process as well.
Senator Pappas. Good. Members, any questions for, where's Susan? Oh, there you are. Hi, Senator Pa, how are you?
Hi.
Go ahead with your question.
Thank you, Chair Housley. So I know you mentioned about project completion and that the project cannot change over the useful life of that, which could be for real estate is 20 to 30 years. How about if, let's say, they need to move to a bigger space because they've outgrown that space and it's within that 20 or 30 years? How would that work?
Assistant Commissioner McKinnon.
Madam Chair, Senator Fa, what happens on these projects is that we have declarations on property. And if there's a sale, if there's a change in ownership such as that, we would require repayment in that case. You've probably heard of this happening to other nonprofits. That is how it would proceed. I have other experience with some of those types of things where we might have done infrastructure awards and new easements have to come in on various property that were state bond financed. The banks, anyone that's involved in the transaction, obviously see our declaration. They contact us, and we go through the process of changing the declaration and or the ownership. And in cases such as if they're selling a building that was financed by the state, yes, we would require repayment.
Okay, even if they're moving to another space that, oh, sorry. Chair.
Senator Pa.
Even if they're moving to another space that's bigger, and the reason why they're moving is because that space is still too small, they could not, I'm just going to clarify, they would not be able to realize any of that, I would say, the dollars that we've appropriated to them to that new project.
Assistant Commissioner McKinnon.
Madam Chair and Senator, that is correct. They could not take those monies to invest in other real estate.
Go ahead, Senator Paz.
Thank you, Chair Housley. And follow up to that, so this has to do with the use and lease agreement. I'm wondering, when you say that the use or lease agreements would have to be approved by MMB, is there a percentage of the space that would be allowable to be leased? And I'm just thinking about, let's say it's nonprofit who leases a small space to another nonprofit to provide similar services that would be kind of wraparound services for their clients. How would that work? Is there a percentage that's a limit on that before they can't?
Assistant Commissioner.
Thank you, Madam Chair and Senator. When you sign a use and lease agreement, yes, you're looking at what types of services and or what is being actually provided in that space. If it's an entirely different use and they're using it for income to help them generate cash, that could present various problems that we would look at. In some cases, I'm not saying any of these, but in previous years, I've seen situations where we actually carve out space for incidental retail to occur, such that that was not financed by state bond funds. But in the case that you're describing, it sounds like it's a very similar use and meets the public purpose of why the state would have invested in that facility. So I wouldn't see that as a problem at all.
Okay.
Senator Pa.
So last question.
Go ahead.
Following up to Senator Pappas's question about the grantees who have yet to have an agreement yet here. I'm wondering, where it says grantee has not yet produced required documentation to advance the grant agreement, how long before those dollars are returned? I mean, how long do we give them before we just say, you haven't provided what's needed, now we're going to return those dollars back?
Assistant Commissioner.
Madam Chair, Senator, these funds are available for 4 years, basically, unless the legislature, for some reason, would take those funds back. And so they're assigned and they're essentially waiting for those projects. Do we want to continue to manage projects that far into the future? No, we would much prefer that they all occur now, and by the time that ends, that they're all done with basically our process. But that's just not how it occurs with a lot of these projects.
Thank you, Chair.
Oh, you're
That's it.
welcome. Senator Papas.
We're kind of doing Pappas Pratt Pa here. Who wants to talk? Assistant Commissioner, just a follow-up from Senator Pa. So if you had to pay the state back, say the state contributed $5 million toward a $20 million project, you only have to pay the state back $5 million. Is that plus interest over 20 years, or is it just the $5 million?
Assistant Commissioner.
Thank you, Madam Chair and Senator Pappas. I don't know the answer to your question. I would suspect not, but I do not know the answer to your question. In other areas of deed, yes, we would require interest. I do not know in this situation off the top of my head, but I would be happy to get you that answer.
Madam Chair, I don't think it happens very often that we've run into that. I have a defeasance bill I'm doing for Gloquet Forestry, and I don't know if that included interest or not.
Yeah.
Senator Pratt.
Thank you, Madam Chair. And this is a really interesting line of questioning. And I'm sorry if I'm going to maybe take this back, maybe take this high-level discussion back to a more remedial level. But, when I look at slide 4, and it says bond funds can only be used for specific items included in the grant appropriation. And I look at the number of, so we've got the municipal projects, and then we have the nonprofit projects. Are all these bonded projects where we're actually selling debt? Or I know we sometimes put together a cash bonding bill, which really isn't borrowing. And are you managing those, and are you treating those like bonds?
Yes.
I'm just trying to understand the difference between the cash portion of the bill and the true borrowing.
Assistant Commissioner.
Thank you, Madam Chair. And Senator Pratt, yes, you are correct. These are both general obligation bonds and general fund projects. And yes, we treat them very similar. They both fall under the 16A that was listed in the capital investment bill. And so once that happens, that's why we work with MMB on a lot of these projects, because they fall under MMB's guidance, contracts, et cetera. And so, yes, we treat them the same.
Senator Pratt.
Thank you, Madam Chair. So I worked on a project that actually had bonding. It dealt with a landfill that was closed many, many years ago. $2 million in bonds. There was $100,000 left on it that we paid off, so that we could utilize that for another purpose. Does each project get its own amortization schedule?
Assistant Commissioner.
Madam Chair and Senator Pratt, I do not know the answer to that. That's probably a question for MMB.
Thank you.
Yep.
Assistant Commissioner, I have a question. So does DEED assign project managers for individual grants, and then that manager follows it through for the full grant cycle? Oh, you're nodding your head yes. So you don't pass it off to another manager going through the different steps of the process?
Madam Chair, that's a really good question. And generally, yes, once we have a project manager, that will stay for the life of that project. Some people leave. In the case of 2 years ago, we didn't have enough project managers to actually manage 120. So yes, there were some handoffs. Yes, there were some changing of project managers. But generally, yes, we like to keep the exact same person through the entire life of the project, which is also why we meet every 2 weeks, because we've brought a lot of new people in to manage this type of funding. And it's not a typical, it's not what most state employees deal with generally when you start using MMB contracts and the 16A guidelines. So a lot of learning has occurred over the last couple of years.
Thank you. Can you describe for these grants, can you describe what the financial review process is provided?
Madam Chair, the financial review, so what are we expecting from the grantee to submit to us?
Yeah, and how do you review it?
Yep. So once there's an appropriation and we have a project named and we assign a project manager to that project, we will ask for basically an application. It's for us to better understand what the project is, what are you trying to accomplish, how does that align with the law, with the eligible expenditures, et cetera. And when we do that, we then start walking through the budget. So how much are you going to spend on construction costs? How much are you going to put in contingency? How much are you going to spend on equipment furnishings and other things to fill out the building? So we're expecting all of that detail. And basically what you do is you match it up a sources and uses table, and hopefully the sources match the uses, and we have a project.
Thank you. Does DEED, somebody asked me this the other day, so I'm just going to ask you, does DEED conduct any on-site visits provided on the grantee's application? Do you ever go out, check out to see if they're there?
Madam Chair, yes, we have to monitor all of these grants, and particularly after you're into a grant agreement with them. That's technically when it starts. However, even prior to that, we generally would either go to the place of business, it could be a city, it could be a nonprofit, or they would come and see us. And so that happens frequently, yes.
So if they come and see you, how do you know they really have something there?
At that point,
An example, yeah.
Madam Chair, at that point, we're talking about an appropriation that the legislature has made for something very specific in a community or for a nonprofit. And we're trying at that point to understand what they're trying to do. And at that point, then following that, they're submitting an application to us. And within that application, there will be things like, do you have a permit at the local level? What is the ownership of the building? What's the tax valuation of the existing building, and what happens after? So there's all kinds of documentation that would be required to actually get into a contract with any of the grantees.
And then I just have one last question from people that they're texting them in. No, how are disputes handled when they occur between a grantee and DEED? How do you handle the disputes?
Madam Chair, that's a good question because and we've talked to the legislature about this, and I know you've talked with many of your colleagues as well, to ensure that our grantees understand that there are requirements that come with these projects, and so we appreciate your help in that as well. When there are disputes, we would understand what the dispute actually is, because sometimes it may be a deed dispute, which we would fully own and try to rectify. It could be an MMB dispute, where then we would facilitate conversations with the other agency to help. And that's generally how we get through these things. Sometimes attorneys have to talk to attorneys. And hopefully we come to a resolution.
Thank you. Senator Pratt.
Thank you. Madam Chair, you just touched on something that raised a question for me. So let's say we have a project for an entity, let's say a nonprofit, as Senator Pott had laid out, and they decide that they need more space, and they sublet the building. What type of reporting or what type of follow-up do you do once the project's complete, but they have this long-term obligation? How do you follow up on that? And then maybe as a second question, have you uncovered any fraud in any of these grants in the recent.
Assistant Commissioner.
Madam Chair, to your second question, have we uncovered any fraud? No, we have not uncovered any fraud.
Or prevented?
At this point. And still working through, obviously, a lot of other pieces of projects that 60 or 70 or so that have not been completed. To the first part of your question, how would we know? There are a couple of longer-term requirement questions that we have certainly on the applications and forms. We do try and follow up and expect annual reports, obviously from the users, but it is something that we're grappling with right now as to how to monitor each individual project over the next 20 to 30 years. What I will tell you is this is a lot easier from a city perspective when money is granted to cities. Generally, you know that's going to remain in city ownership for as long as the useful life. We don't know what that might look like yet from the nonprofit perspective. Previously, in previous years, we would give money through, let's say, the city of Shakopee, and Shakopee would then work with a nonprofit. In 2023, we went directly to the nonprofits themselves. And so as we go a little further along in this process, those are things that internally we are going to have to grapple with and ensure that we are monitoring and keeping tabs on that for the life of the projects.
Senator Pratt, follow up.
Yeah, just a quick question. Have you or are you taking lien positions in those properties to ensure that they stay in their intended purpose?
Assistant Commissioner.
Madam Chair, Senator Pratt, yes, we require first lien on the property, and that can be a challenge in some of these projects where we have to work through some of that with bank financing that's going into some of these deals. Sometimes there's new market tax credits that have gone into some of these deals, so it can get very complicated. But yes, we ensure that we are in that first position.
Thank you.
Yeah.
Senator Nelson.
Oh, thank you, Madam Chair. The discussion about the difference between a bond project with a public entity, which we've done for a very long time, and not doing it that way, but going directly through the nonprofits. I know that's a relatively new avenue. And I just wanted to kind of, if you are able, to talk a little bit about the difference in managing those type of grants. I know some on this committee will remember the Reading Center, which was a great bonding project several years ago. And we had to have I would say sponsor, but I actually think that's the wrong word. We had to have a public agent. In other words, in this case, it was the county, Olmsted County, who kind of worked through that project. And I know it was an immense amount of work. I talked to my commissioners, very thankful. And they said, well, this was really difficult, but we got it done. And so I just would like you, if you feel that you can, so it's a lot of work for our nonprofits to go through a state, a city, or a county for these bonding projects. I understand that. But also there might be some additional protections there. And do you have any sense on which is a better way? I realize that's a very hard question because every project is incredibly different. But what would your inclination be if a project could work through a local government, for example, as the, what's the word? It's not a public agent, but the recipient of the funds. Or going directly.
Madam Chair.
Pardon me.
Senator Pappas.
It's the owner.
The owner?
The city owns the
Yes,
property.
exactly, right. But I'm just wondering if what your thoughts are regarding those two different ways. One is a lot more laborious for the for the governmental entity to take on the work with the nonprofit. The other is directly to the nonprofit. Can you just kind of describe the differences and what your thoughts are regarding safety, preferability, all that type of thing?
Assistant Commissioner.
Madam Chair, Senator Nelson, I think when you deal with, even with some of the small cities that receive general obligation bond funding, the sophistication of grantees that are receiving it can be all over the board. And generally, when we're dealing with cities, most cities have law firms that they're contracting with and can help them through some of the requirements to understand what's actually in this. In the case of using the city to pass through funding on to the nonprofit, if I put myself in their shoes, they're not receiving any money or any staff time to actually do a lot of the work to work with the nonprofit. Because as you indicated with your example, it is a lot of work on the local unit of government. So going directly to the nonprofit cuts that out, and certainly helps the cities and or counties wherever this facility is going to be located with that. When you're going directly to the nonprofits, that can also be challenging as well, because the nonprofits may not have the appropriate legal counsel, they might not have the resources that they might need to hire the right people to understand exactly all of the requirements that go through these agreements. And so what I would say is that we have, well, in my 17 years at DEED, we've always worked with local units of government. We have good relationships with our local units of government. They generally know exactly what we're talking about when we expect documents. They know how to deal with Minnesota management and budget. This is new to our nonprofits, and so we've had to work through a lot of questions and concerns, but as you can see on the list, many are getting through it. We've got over 30, I think it's 37 that are completed, and so there are a lot of people that were ready, that understand it, have the appropriate teams, but there are some that maybe lack that that support that they probably need at some level, and that's another thing that that could be delaying their project right now. They've had to bring in appropriate advisors to help them structure the deal, help them with fundraising, et cetera, in order to comply with our requirements.
Senator Nelson, follow up?
Yeah, just to follow up, this might be for staff. So my memory is that at one point, all bonding projects, it was the fiscal agent that needed to be a public entity, I believe.
Right.
And at what point did we change that? We must have changed that statute at some point if we now have a bonding for nonprofits, which are not public. So the fiscal agent is not a government entity, it's a nonprofit. When did we change that to allow, I'm not saying it's bad in any way, I'm just saying that, when did we change that statute that required that no longer would require a fiscal agent be a elected body?
Ms.
Government.
James?
Madam Chair and members, the Constitution requires that for any bond proceeds, the owner of the property be a public entity. Nothing about that has changed. That's just the way it's always been. There are some situations where public entities have chosen to lease publicly owned property to a nonprofit to carry out a public purpose. And so in those cases, it's still not just a fiscal agent, that the city or the county is still the owner of the property. And then in recent years, when there's been a cash target available to the committee that goes beyond the amount necessary to pay the debt service, the committee has appropriated general fund money. It's appropriated to an agency for a grant to nonprofits.
Senator Nelson.
That was a great history that kind of put all these different projects that I've recalled over the years kind of in exactly maybe the category or the method for doing that. So thank you, Ms. James.
Thank you, members. Senator Pappas.
Senator Pappas, of course. So Senator Nelson places in St. Paul like the Science Museum, the Ordway, are actually owned by the city. The actual Excel Arena is owned by the city, and then has a long-term rental agreement with the nonprofit, or in this case, the Wild. My question is for Deputy Commissioner. We try our best to prepare entities, whether it be local governments or in the past nonprofits, but mostly we tell them they have to fill out the MMB form, which requires them, an updated MMB form, not just during the every 2-year request from the state. Are there other things that we could do to kind of better prepare communities, or maybe perhaps in the future nonprofits, so that they're less of a headache for you, so that they're more prepared?
Assistant Commissioner.
Madam Chair and Senator Pappas, I think explaining some of the intricacies of what this means is always helpful, and with many projects, we don't really get exposed to them until they're actually in the capital investment bill, and so now that we are probably at the point where what has occurred in the last couple of years, we have a little more capacity, I would say, to actually focus on some of these potential appropriations that might go in there, and the organizations who would be receiving them. And so if there's ways that we could also help support earlier, we'd be happy to look at that as well. Moving forward as well, in some cases you want to help and you want to do what you can to get these grant contracts completed. But at the end of the day, this is on the projects. They have to be the ones that have the capacity, have the fundraising, can do these things in order to comply, and so again, making sure that people understand what these requirements are going to be is absolutely critical. And so appreciate your help in that, and we will help as we can as we go through the process.
Senator Pappas.
Thank you, Madam Chair. And I had a couple ideas about maybe doing workshops might be helpful, either by Zoom or probably by Zoom would be best. I was just thinking about, I was kind of really anxious to kind of get the money out the door and get these projects moving. And I know it took Deed a while because you had to hire people because there were so many projects. Now, since we didn't do a bill last year, I'm thinking, well, this isn't such a bad idea that some weren't ready to go, because now as you've checked all these others off the list, now you have more time to deal with this next group, and they had more time to fundraise. And also I worry a lot about the construction seasons, quite frankly, when we have a big bonding bill and all the construction companies go out and hire people, and then when we don't do one, then they lay everyone off and people leave the state, and then we have to, I'd like to see us kind of even that out a little bit more, and certainly by these grant agreements being more paced over 4 years is something that does help with that as well.
Thank you.
Okay, you're good?
Yep,
Yeah.
I'm
All
good.
right.
Thank you.
Members, any more questions? All right, there being no further business, the Senate Capital Investment Committee is adjourned. Thank you for coming.
Thank you, Madam Chair, members.
Thank you. So did you?